Hi, I'm Sarah Benwell, the editor of fundoperator.com, and I'm here with Gilles Moëc, AXA Group Chief Economist and AXA IM Head of Investment Research. Gilles is speaking at the Institutional Fixed Income Summit in November, and ahead of that, we wanted to have a quick chat with him to find out what he's going to be talking about. Hi, Gilles.
Hi.
Hi. So I guess you're talking about inflation, and so my first question is, how worried should investors be about inflation?
Maybe not too much, because the current inflation spike, generally speaking, is probably of a transitory nature. Yes, it's likely that in some regions, in the US and in the euro area, inflation will end up being on trend higher than what it was before the pandemic. But I would argue that it's a good thing, because the super low inflation rate that we had before the pandemic was not good news. No good news for central banks, because they were constantly forced into weird, unconventional policies, and not good for investors, because obviously that was consistent with very, very little interest rates on riskless assets. So not such a bad thing in general. It's the period before the pandemic that was weird. And let's have a look at how it unfolds in the next few months. It's probably going to be a bit painful, but I don't think we have the ingredients for runaway inflation, runaway 1970s type inflation. The labor market has changed a lot across the advanced economy. So yeah, probably more relaxed than a lot of my peers.
Great. And what about in the UK? How does the picture look there?
This is where I would say things might be a bit different, because inflation was extraordinarily low in the US and even to a greater extent in the euro area before the pandemic. That never really happened in the UK. Inflation very often was actually above the Bank of England's target, and the governor had to write those tedious letters to the chancellor. So there was no issue with inflation being too low in the UK. There is nothing to catch up there. There is nothing to re-anchor there. And there are structural reasons to think that inflation could remain quite high beyond the transitory shock that we're experiencing right now, because of the labor shortage, for instance, that leaving the EU is creating. Not much central banks can do about it, honestly. I don't think that the Bank of England has a lot on in its arsenal to deal with this sort of supply side inflation shocks. But yeah, it's a country where we could see purchasing power in particular being very often eroded by strong inflation.
Great. And last one, how can investors turn this inflation into an opportunity rather than a risk?
Honestly, I think that what this all should create, not immediately because we're still dealing with the immediate aftermath of the pandemic crisis, but in 2, 3, 4 years from now, we should be able to have a normal interest rate curve with actually something in positive territory. So that will recreate, actually, I would say, a normal or more normal situation on the yield curve. And with higher general level of interest rates, that should be also consistent, with obviously bouts of volatility, but volatility is also how trades get made. So yeah, I mean, if I'm right, we will end up in a sort of more normal world, with, from this point of view, more investment opportunities than the sort of extraordinarily dull financial world we've had for years.